Silver isn't rallying. It's slipping out of its old pricing cage, and the paper market is already trying to frame it as a temporary frenzy. Not because they love drama, but because this is the safest story to sell when a metal starts behaving like a shortage instead of a chart. And here's the part most people missed. The real signal is the headline price at all. It's the gap between where silver is priced and where silver is being pulled. Stay with me, because by the end, you'll have three things most coverage never gives you. The hidden detail that reframes this whole move, the calendar trigger that explains why it's happening now, and the two levels that decide whether this turns into a routine spike or the beginning of a repricing event that drags $100 into the conversation faster than anyone is comfortable admitting. And that's where the real pressure starts. Over the last stretch of trading, silver didn't just grind higher like a normal commodity. It surged into the kind of territory that forces risk managers to tighten their grip, depending on where you watch it. Spot screens, futures prints, intraday extremes. You saw silver test into the low to mid-90s. And then you saw the other side of the move too. A sharp snapback that looked violent, messy, and irrational. But that snapback is exactly what a stressed market looks like when it's trying to reprice while leverage is still sitting on top of it. Short bursts up, sharp whips down, then the next wave. Because if this was just emotion, it wouldn't be so mechanical. And that's not the part that matters. The part that matters is what those moves force participants to do in real time. When price jumps that fast, margin requirements go up, positions get reduced, dealers hedge differently, and liquidity thins right when everyone needs it most. That's the recipe for a market that starts printing price and then printing consequences. You can feel it long before you can prove it with a clean chart. You feel it in spread behavior. You feel it in the way bids disappear for a second and then reappear higher. You feel it in the way normal pullbacks suddenly become air pockets. And here's the tell. In a normal rally, the story is bullish and everyone feels smart. In a stressed repricing, the story is chaotic and everyone feels uncomfortable. Silver is in the uncomfortable phase. But we're not going to do the usual thing where we stare at candles and pretend that's analysis. We're going to start where real markets always start, with symptoms on the street, with mechanics under the hood, and with the global tug of war that decides where the next dollar comes from. Because the moment you understand that tug of war, you stop getting emotionally farmed by volatility. And that's the point. When a commodity is truly tight, the first evidence isn't a viral headline, it's friction. Things don't flow as smoothly. You see higher transaction costs, wider spreads, longer lead times, more out-of-stock language, and buyers acting like they're late. It's not always dramatic. Sometimes it's subtle. A small premium here, a delivery window there. A dealer who used to quote instantly now asks you to wait. Those aren't anecdotes. Those are early warning lights. And when the price is ripping, those lights matter more, not less. Because the visible price can be a mirage of leverage while the physical market is sending a different message. But that's not the part most people focus on. Most people focus on the number on the screen and then they pick a team, bull or bear. That's how you get trapped. Because silver is one of the most emotionally weaponized markets in finance. It's small enough to squeeze and large enough to intimidate. It's industrial enough to explain away and monetary enough to panic bid. And the same volatility that attracts people is the volatility that removes them at the worst possible moment. Which is why you need to understand the hidden detail right now before the next swing tries to convince you that the thesis is dead. Here's the hidden detail. The price you're staring at is the least important number on the screen, because the real warning lies in the gaps between markets. Silver is global, but it doesn't trade like one unified pool of water. It trades like connected reservoirs with valves, frictions, and gatekeepers. When those valves open smoothly, the differences between regions are small, and the arbitrage keeps everyone honest. When those valves clog, because of logistics, financing, regulatory friction, or sheer scarcity, those differences widen. And when differences widen, the official price can lag the real price people are paying to get metal now. That's why this move has institutions paying attention even if they pretend they're not. Because institutions don't need to believe in a story. They need to manage the risk of a dislocation becoming self-reinforcing. And that's where the setup flips. Let's simplify the battlefield. There's paper silver and there's physical silver. Paper silver is futures, options, swaps, contracts that represent exposure. Physical silver is bars, rounds, industrial feedstock, metal that has to be mined, refined, shipped, assayed, stored, and delivered. Most of the time, paper and physical track closely enough that people treat them as the same. But they're not the same. They only behave like the same thing when the system can deliver metal easily enough that paper claims don't outrun physical availability. When you hear people talk about price suppression or manipulation, ignore the cartoon version. The real story is incentives and market structure. Futures markets exist to provide liquidity and hedging. They also allow enormous nominal exposure relative to the size of the physical market because most contracts are never delivered. That's fine until delivery starts to matter. That's the crack in the wall. When delivery starts to matter, paper becomes a promise that competes with real metal. And competition is where repricing begins, but that's still not the full mechanism. The full mechanism is how tightness shows up first in places most people never look. One of those places is inventory categorization. People hear warehouse inventories and imagine a pile of free supply waiting to meet demand. In reality, inventories in these systems often split into categories like deliverable on warrant versus merely stored, eligible, or earmarked. In plain language, some of that metal is actually available for delivery against futures. Some of it is just sitting there, owned by someone, not for sale, and not automatically deliverable. That distinction is everything when the market is stressed. Because in a squeeze-like environment, the only inventory that matters is inventory that can satisfy the contract without asking permission, without re-registering, without delays. This is why you can see total holdings look fine while deliverable channels get tight. And if you think that's too technical, here's the translation. When deliverable supply is tighter than people assume, anyone who is short and needs to deliver has fewer exits. And that's where price discovery starts slipping away from the headline print. But here's the twist. Even if you never intend to take delivery, the delivery mechanism still controls the psychology of the market. Because participants know that if too many claims chase too little metal, the system forces repricing through the one thing nobody can argue with, the cost of making good on the promise. Now let's talk about the signal that reveals that cost without anyone needing to confess it. The term structure. In a relaxed market with ample supply and easy financing, you often see later prices above near prices, contango, because you're paying for storage and carry. In a stressed market with urgency, you can see near prices above later prices, backwardation, because the market is effectively paying you to get metal now. It's the market saying immediate availability is worth more than theoretical future supply. And once that shows up, it changes behavior. Because if you're an industrial buyer, you don't care about a 6-month forward quote if your production line needs feedstock now. If you're a trader, you don't want to be short nearby contracts when the nearby premium is rising. If you're a vault operator, you notice metal moving in ways that don't match the calm story. But that's not the part that matters. The part that matters is what happens when this tightness meets global price magnets. Because silver isn't just a US futures story or a London spot story. When one region is willing to pay materially more, whether through a premium, a different benchmark, or a persistent spread, that region becomes a vacuum. Vacuums pull metal, vacuums pull flows, and vacuums eventually pull the global price. Not because of narrative, but because arbitrage becomes irresistible. Here was arbitrage in one clean image. If silver in region A is effectively worth more than silver in region B, that pressure lifts B's price and can cap A's premium, but only if the valve is open. Metal must be able to move, financing must be available, and regulatory or logistical constraints can't block it. If the valve is partially closed, the premium persists, and that persistence is the hidden detail, because persistent premiums are the market admitting that paper pricing and physical pulling are not aligned. And when they're not aligned, something has to give. Either the premium collapses because supply flows freely, or the benchmark price rises to close the gap. That's the tug of war. That's the magnet. And when you watch silver through that lens, the recent surge looks less like random hype, and that's where the real pressure starts. Now layer in the calendar. This isn't happening in a vacuum. This is happening into a calendar where liquidity, forced flows, and delivery timing collide. Early in the year, you often see systematic rebalancing in commodity indices and funds. Those flows don't believe anything. They don't care about narratives. They care about weights, rules, and schedules. When those forced flows hit, they can push price around in ways that look irrational, but they also reveal where real demand is waiting underneath. Think of it like stirring a pot. If the bottom is empty, you just swirl water. If the bottom is crowded, you hit resistance. Forced flows are the stir. The market's reaction is the resistance. And when you combine forced flows with rising margin requirements, you get something even more important. A leverage purge that can temporarily smash price while tightness signals remain. That's the trap that catches people. They see the smash, they assume it's over, and then they watch price rebound because the underlying stress never left. Which is why you need a 2-scenario framework, not a one-direction fantasy. When a market moves violently, clearinghouses don't sit back and admire the candles. Higher margin means you need more capital to hold the same exposure. That forces weak hands out and reduces leverage. It can cause cascading liquidations. It can also set the stage for the next leg higher if the selling is mostly forced and the physical bid remains. So margin hikes aren't moral judgment. They're a smoke detector. But that's not the part that matters. The part that matters is what happens after the leverage flush. If spreads stay tight, if premiums stay elevated, if demand doesn't vanish, then the system has just removed the dampener. And a market without dampeners reprices faster. Now, I want to address the obvious question you're already thinking, because skeptical viewers are the only viewers worth keeping. Is this just a blow-off top? Yes, silver is famous for punishing certainty. That's why the only sane way to approach this is with mechanisms and invalidations. Not vibes, not prophecy, mechanisms and invalidations. And that starts with the most misunderstood force in modern markets: options reflexivity. You just need to trade a market where options positioning is large enough to move hedging flows. Here's the simple version. When people buy call options, the dealers who sell those options often hedge by buying the underlying as price rises. That hedging can become self-reinforcing in certain zones, especially around big round numbers where lots of strikes cluster. If price starts moving toward those zones, hedging demand can accelerate the move. That's a gamma-driven dynamic. As price rises, the hedgers buy more, which pushes price further, which forces more hedging, and so on. And silver is thin compared to the ocean of capital that can rush into it when the narrative turns. That's why 90 cheers to $100 zones can feel unstable. They're magnets for both human emotion and mechanical hedging. But that's not the part that matters. The part that matters is what happens when the mechanical bid meets physical stress. If the move is purely options driven, it can fade when positioning rolls off and hedging demand disappears. If the move is also driven by physical pulling and regional premiums, then dips get bought differently. They get bought by procurement and by arbitrageurs, not just by momentum traders. And that distinction is everything for what comes next week and next month. So let's build the proof stack the right way. Multiple layers, not one argument. First layer, the price behavior itself. A rapid push into new territory followed by violent pullbacks is consistent with a market transitioning regimes. In a stressed regime, price discovers that it's too low and tries to jump, then leverage forces it back, then it tries again. That's the rubber band effect. Second layer, risk controls. Rising margin requirements and tighter conditions tend to show up when volatility is no longer contained. That doesn't prove tightness by itself, but it proves stress. Third layer, term structure behavior. If nearby tightness shows up, backwardation or unusually firm near-month pricing relative to later months, that suggests urgency and a bid for immediacy. Fourth layer, inventories and availability, especially deliverable channels versus total holdings. If the deliverable pipeline is tighter than the public assumes, then paper shorts have fewer exits. Fifth layer, cross-market dislocation. If a major region persistently pays up relative to Western benchmarks, that's a vacuum-pulling metal, and it either resolves through flow or through price. Sixth layer, on-the-ground symptoms, premiums, lead times, procurement behavior, where real buyers reveal their priorities. None of these alone is definitive. Together, they form a pattern. And the next detail is what flips the whole setup. The next detail is macro. Silver is the weird hybrid metal. It's an industrial input and a monetary shadow. When macro anxiety rises, currency stress, inflation uncertainty, geopolitical friction, distrust in policy, precious metals catch a trust premium. Gold usually leads. Silver often lags and then overshoots because it's thinner and more volatile. When gold is strong and the environment rewards hard assets, silver becomes the high beta expression of that mood. But silver also has its own industrial pull. Solar, electronics, electrification themes that are real and persistent, even if the narrative around them is sometimes exaggerated. The key point is not solar will moon silver. The key point is that the demand base is broad enough that when investment demand reawakens, it's piling on top of an already busy pipeline. And pipelines don't expand overnight. Silver supply is constrained not just by mining, but by the fact that a lot of silver production is byproduct of other metals. That means you can't simply decide to produce more silver because the price went up. You need upstream decisions in other markets, and you need refining capacity. You need time. In other words, you can't scale silver like software. That's why tightness can persist longer than people expect, and why the market's first instinct is to deny it. Because admitting tightness means admitting price must do the rationing. And price rationing is political, emotional, and financially dangerous. Because if you don't model the failure modes, you're not analyzing, you're cheering. Failure mode 1, leverage, liquidation, cascades. If price whips and margin rises, participants who are long and overextended can be forced out, creating fast drops that feel like the end of the world. Failure mode 2, narrative reversal. If macro conditions suddenly shift, real yields spike, the dollar surges, risk assets crash and drag everything down. Silver can get hit regardless of fundamentals. Failure mode 3, premium collapse due to reopened valves. If logistics ease, financing cheapens, or regulatory frictions loosen, arbitrage can close regional gaps without requiring the benchmark to rise. That would relieve pressure. Failure mode 4, demand destruction at the margin. If price rises too fast, some industrial buyers can delay, substitute, or reduce usage, especially in price-sensitive segments, which is why the only credible approach is a two-scenario lens. Scenario 1 is the controlled pullback and retest. Price pulls back from the highs, tests a prior breakout zone, volatility cools slightly, the market builds a base. In this scenario, you'd expect the tightness signals to remain stubborn even as price retraces. Spreads would not fully normalize. Physical premiums would not collapse. The market would feel heavy, but supported. Dips would be bought, not chased, and the next leg higher would come with less drama, but more durability. Scenario 2 is the continuation, squeeze, and gap risk. Price refuses to give you a clean retest, liquidity thins, positioning gets trapped, and you see discontinuous moves, overnight gaps, sudden spikes, violent intraday swings. In this scenario, options dynamics can amplify everything. Shorts can be forced to cover into strength, and risk managers can cause abrupt flushes that reverse just as fast. This is where people get emotionally shattered, because the thesis can be right, and your timing can still get destroyed if you're over-levered or mentally unprepared. And that's where the real pressure starts. Now, the why now draw matters because it tells you which scenario is more likely in the near term. With forced flows, rebalancing windows, and elevated margin in play, the market is primed for messy action. It also means this is a time when false signals can appear. A sharp drop doesn't automatically mean the repricing is over. A sharp spike doesn't automatically mean the squeeze is confirmed. You need a checklist that is harder to manipulate than your emotions. Here's the checklist in plain language. If silver is truly in a repricing phase, stress will refuse to relax. You will see continued evidence of urgency in the structure, near-term pricing staying firm relative to later months, persistent regional premiums, and a market that rebounds after flushes because real demand absorbs the supply that leverage dumps. You will also see the gap theme persist. Different prices in different places, different availability in different channels. If, on the other hand, this was mostly leverage and hype, then after the initial fireworks, you'll see the tightness signals fade as quickly as the headlines. Spreads will normalize, premiums will compress, the market will start behaving like a normal carry commodity again, and price, without structural support, will struggle to reclaim the prior highs. That's not prophecy, that's how these setups resolve. So what are the levels? I'm not going to insult you with fake precision because markets don't respect it and neither should you. But conceptually, the battlefield is clear. There's the psychological zone that just got tested, the high volatility region around the 90 handle and above. That's where the market discovered it could trade there, and it's where it will either accept that territory or reject it. Above that, the next big magnet is the round number everyone can see, $100. Round numbers matter because humans cluster orders there and because options positioning tends to cluster there. If price pushes toward $100, the market can behave like a pressure cooker. One more turn of the lid and it hisses, then it whistles, then it blows steam. Below the recent highs, there's a zone where acceptance would look like strength. A pullback that holds above key prior breakout areas instead of slicing through them. If price can't hold that acceptance zone and the structure relaxes at the same time, that's your warning that the move was more fragile than it looked. And that's not the part that matters. The part that matters is what the market forces participants to do at each zone. If price holds firm and structure stays tight, shorts feel trapped, dealers hedge more, and physical buyers get nervous. If price breaks lower and tightness fades, longs de-risk, dealers unwind hedges, and the urgency premium evaporates. Those are two different movies. Your job is not to predict the ending. Your job is to identify which movie you're in before you pay full ticket price emotionally. Now, let's address the institutional angle without turning this into cartoon conspiracy theater. Institutions care about silver when it becomes a system risk, a hedging cost, or a liquidity event. They don't need to believe silver is going to some magical number. They just need to see enough evidence that volatility will rise, spreads will misbehave, and correlations will break. When that happens, they adjust. They reduce exposure. They demand more collateral. They widen bid-ask. They hedge more aggressively. Those actions can make the market feel suppressed because rallies get slapped and liquidity disappears. But what it really is risk management. And risk management doesn't stop a repricing if the underlying stress is physical and global. It only changes the path. It makes the path more violent. Which brings us to the viewer psychology shield, because this is where most people lose money and credibility at the same time. The market will try to manipulate you emotionally, whether or not any human is deliberately manipulating anything. Because volatility itself is a weapon. You will see a green surge and feel regret. You will see a red candle and feel fear. You will see an "it's over" headline and feel relief, then watch price rebound and feel foolish. That cycle is how markets transfer wealth from impatient hands to disciplined hands. The antidote is simple. Decide in advance what is signal and what is noise. Signal is structure, spreads, premiums, acceptance at key zones, persistent urgency. Noise is the day-to-day emotional theater, a tweet, a pundit, a single intraday wick. This doesn't mean ignore price. It means interpret price through the mechanics. If you see a violent drop on rising margin and thinning liquidity, that can be forced selling. Forced selling is not the same as fundamental selling. If you see a violent spike into a round number zone with obvious options, gravity, that can be reflexive hedging. Reflexive hedging is not the same as durable demand. The trick is to watch what happens after. Does the market stay stressed? Does it revert to calm? That's the clue. And here's the most important psychological rule in silver. Price can whip around violently even if the thesis is correct. That sentence should be tattooed on every silver chart. Because the number one way people get destroyed is being right and still getting shaken out by volatility, leverage, or emotion. If you're going to engage with something as sharp as silver, you need a time horizon and a risk plan that can survive the whips. Not because I'm giving you financial advice, not, but because the market doesn't care about your conviction. It cares about your ability to hold your exposure through a storm. Now, let's bring it back to the hidden detail and make it actionable. The hidden detail was the gap between markets, the dislocation. That's the metric you watch. Does the gap persist or does it close? If the gap persists, pressure persists. If the gap narrows because the benchmark rises, that's repricing. If the gap narrows because the premium collapses and the structure relaxes, that's relief. Same outcome on the surface, gap closed, two completely different implications. And that's where the real pressure starts. So what comes next? Specifically in the next 1 to 2 weeks? Expect volatility. Expect attempts to paint this as over. Expect sudden squeezes that feel like they come from nowhere. Expect liquidity to be thin at the worst possible moments. Overnight sessions, around big round numbers, around key calendar windows. If the market is leaning short or underhedged, you can see sharp upward bursts as positions get forced to adjust. If the market is leaning long and over-levered, you can see abrupt downdrafts as margin and risk controls bite. Both can happen in the same week. That's why the two-scenario lens matters. In the controlled retest scenario, watch for price to pull back. And then hold a meaningful zone, somewhere that looks like acceptance rather than rejection, while structure remains firm. In the continuation squeeze scenario, watch for price to reclaim the highs quickly after flushes, and for round number zones to act like magnets rather than ceilings. And always watch the plumbing. Do spreads stay tense? Do physical signals stay sticky? Does the global vacuum keep pulling? Because if those remain, the repricing thesis stays alive, even if the screen is trying to scare you out of it. Now let's talk targets with humility and usefulness. Targets are not guarantees. They're reference points where behavior changes. The first obvious target is the psychological magnet at $100. Not because $100 is magical, but because it is where positioning, headlines, and hedging collide. If silver approaches $100 with structure still tight and liquidity still thin, you can see acceleration, either straight through or a violent rejection followed by another attempt. Above $100, targets become less about neat lines and more about volatility regimes, because once a market enters a new price bracket, it searches for acceptance. That search can be explosive. But targets without invalidation are just hype. So let's define invalidation in a way that respects the mechanics. Invalidation isn't price goes down. Price going down is normal. Invalidation is price pulls back and the tightness signals fade at the same time. Spreads normalize, premiums compress, urgency disappears, and the market reverts to a calm carry structure. If that happens, then what you witnessed was likely a leverage event more than a structural repricing. If instead price pulls back and the stress remains, if dips are absorbed, if the plumbing stays tense, then you're looking at a market that is trying to reprice but is being forced to do it in a disorderly way. That's what real repricing looks like. Ugly, loud, uncomfortable, and consistent in the underlying mechanics. Now here's the checklist for next week, the kind you can actually use without becoming a chart astrologer. Watch whether the market respects the big zone it just fought for. Does it regain it quickly after dips, or does it get rejected repeatedly? Watch the behavior around round numbers, because that's where options and psychology collide. Watch for signs that forced flows and risk controls are still dominating. Big intraday swings, sudden gaps, margin-driven liquidation style action. Watch whether physical signals remain stubborn, availability friction, premiums, persistent regional pull. And watch for the one thing nobody wants to say out loud, whether the global pricing system is staying aligned or drifting. If it drifts, repricing pressure builds. If it realigns calmly, pressure eases. That's it. And if you're still here, you already know you're not the average headline chaser. You're the kind of market watcher who wants mechanisms, not motivation. So here's my quiet CTA. Not a plea. Stick with people who respect uncertainty but still track the real signals. That's how you build an edge in markets that punish ego. You don't need to be loud. You need to be early, disciplined, and hard to shake, because volatility is coming and it will be used against you. The market will try to convince you that every spike is the top and every dump is the end. Your job is to watch the plumbing, respect the calendar, and let the structure tell you which scenario you're in. And if that 90 plus territory gets accepted again, while the global gaps stay wide, the math changes fast. If it fails and the stress relaxes, you step back and you keep your powder dry. That's professional. That's how you survive silver. And that's how you catch repricing without becoming exit liquidity for the loudest story in the room.